Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing tonight? Hope all is good. Stick with me for a little bit. We're going to go over Dave Ramsey and Suzy Orman. We're going to pick on them a little bit, but we're not going to bash them, okay? We're going to enjoy some of this bare face, getting towards about a half a bottle left there. Every night we've been kind of trying to get familiar with it, and it's growing on me, but don't make an old-fashioned with it. Anyways, I'm going to go over a bunch of reasons why Dave Ramsey and Suzy Orman's advice can be expanded on, right? Keep in mind that my philosophy has always been anyone who can motivate or educate someone financially is a winner. I don't have to agree with them. I don't have to take the same approach, but anybody that can do that, my God, you know how hard it is to get people, your kids, for example, to be excited about finance. If they can do it, I'm all for it. I do find that we can expand on it and make it a little bit better. So please don't think that I'm bashing on anybody here. I grew up a Suzy Orman fan, to be honest. And if you want, I'm going to date myself a little bit. Bruce Williams. How many of you go back to Bruce Williams, man? That was my idol. And he did not have really step by step, like the baby steps like Dave Ramsey does. But man, I love that guy. The tough love of finance. That just, ate me apart, man. I loved listening to that guy. Anyways, if you're younger, you won't know who that is. So let's take a look. All right. The first thing I want to say is planning for retirement is unique and special to you. It is more complex than just saying save 15% of your savings. Now, Dave Ramsey and Suzy Orman take an approach that I would like to add something to. I'm going to say that's a starting point, but I'd like to expand on that. We're going to look at a bunch of different reasons here. Now, what we did here is we took the total audience over the lifespan of Dave Ramsey, the total current audience of Suzy Orman. And we said, well, let's look and see how much their plans would have fit within that audience, right? So it's not going to be a really high number. 90% of people inside of that had different financial starting points. That's obvious, right? Guy calls the show. Dave Ramsey's like, hey, I got $2 million, I'm thinking about buying a Lamborghini, whatever. And he gives him a hard time. Okay, fine. Next guy calls and he's like, my wife spent money and she didn't tell me. We're in credit card debt, right? They're different financial situations, so that's normal. Unique life goals, I'm surprised didn't come back as more. 85% of people have more unique life goals than what their systems can account for. And that's fine too. Varied risk tolerance. Honestly, I would think that would have been a lot higher. We have now over 4,000 clients all over the United States. And that's probably the number one thing that we focus on is risk tolerance, because when the markets fall, some people don't care. Some people panic. Some people are like, you didn't tell me this is going to happen. So risk tolerance is really, really important and not really focused on by especially Dave Ramsey. He just says, go in these mutual funds and that's it. Life expectancies ranks at the last point, and that's just because that's not brought up with everybody inside of those conversations and all the data that we could find with those two. Now, when you look at Dave Ramsey and Suzy Orman, the common theme is delayed gratification, right? So spend less now, save more now, pay off debt now. Nothing wrong with that. I would like to expand on that and say, this is from my own life, right? I'm 42, about to be 43. And what I've started to realize is I want to strategize for things that I'm capable of doing now, right? One of those things, side topic. You guys can make fun of me. It's fine. Like grab a drink. I hope, you're having your glass of wine or whatever you're drinking. You can make fun of me. I literally just told my best friend today, I want to do a survival trip with you. I'm not saying I'll do well, but I'm saying I want to go to some mountain somewhere, do like a day training, the knife, the flint, all that stuff, and have them drop me off and go, okay, you got to figure out how to survive. Can I do that when I'm 65? I hope so, right? I mean, I'm not saying 65 is old, but could I do that in an official retirement, right? I feel like I'm getting more of like the honey and caramel out of this bare face. Anyways, so let's go back. So they take the idea of let's sacrifice now for a better future. Yes, okay, most things that would apply. Sacrifice now so that you can maybe retire earlier or something. But let's not make it a one-size-fits-all thing. If your dream is to learn how to wakeboard and jump the ramp, good for you. I'm not going to do that. But we probably need to strategize for that earlier in your life. So Dave Ramsey's approach and Suzy Orman is basically have less fun now and save it for the future so that Dave Ramsey has a quote where like, do things that no one's doing now so you could do things that no one's doing in the future, right? That's a great quote. However, let's just make sure you're able to do it, right? Delay gratification, save aggressively, all of that stuff. The more balanced approach would say, let's be more detailed. Let's be more strategic about your savings there. Let's balance now and still enjoy the future, right? Let's get into some details here. They say I say not all debt is bad. They say all debt is bad. And Dave Ramsey doesn't actually kind of distinguish. It's just debt is bad, right? And that's the stance he takes. Again, he's motivating the hell out of people to not have debt. I'm not going to fight that. However, we have a unique generational event where a lot of people have mortgages for 1%, 2%, and 3%. Ask yourself, is it better to pay down 3% debt when a money market fund pays you now 4.5%? That's a small spread, right? The answer could be, well, I don't want the debt. Fair. What if you could earn more on that money? I'm not saying you do it. I'm just saying, like, think about it that way. We now have an environment where mortgage rates are, 6, 7, 8%. I don't know, something not 2 or 3%. Okay, well, now we're back to that discussion of, I don't know. You might want to pay off that mortgage debt before you do anything more aggressive. So I get that. There was just that one moment in time. Car loans. You get a car loan for 0.1%. My God, that was so rare. And so that leads into like, hey, instead of prioritizing paying off your mortgage so you can move on to other forms of wealth building, maybe it doesn't make sense. You are maybe uniquely different where it doesn't make sense. The 15% savings. I picked on this the other day. I'm kind of a stickler on this. This is one I would fight back on. There is nothing wrong with saving 15%. And as you'll see in a second, there's a reason why Dave Ramsey says this. But I'm kind of a stickler on this. Like, why save 15% if you only need to save 11.5? Like our planner in our portal, we built it ourselves. Nobody else has it. We like to focus on that. You tell me this is your goals and everything you want to accomplish, you need to save 9.2% of your income. I would rather know the exact number, even if it was higher. If it was 17%, that's okay too. But I'd rather know the exact number. He does a really good job of saying you can't go wrong with 15%, right? He did the math. I'm not saying he's stupid, but like that's a good general answer. I want to expand on that and say someone should run that number for you, right? Now, credit card debt, really no benefit to that, right? I will argue that with these people all day long. Credit cards are such a stupid ripoff. I can't believe that we don't focus on that or somehow try to, it's America. They could do what they want, but it's like, okay, that's a ripoff. You know that, right? Car loans, okay. There's a time period where car loans were super cheap. Even leasing a car versus selling it back after the end of it, there was a spread there that doesn't exist anymore. Student loans have a high potential benefit. There's a lot of risk involved there because you can't just walk away from a student loan. And mortgages, of course, like it has a high benefit over the lifetime. If you're going to live in a house for 2 years, what are we doing, right? You need to put a lot more down. If we're moving on here, Dave Ramsey does not like ETFs so much. I thought potentially he was sort of coming around to that. Being in the investment world, I will say you shouldn't discount ETFs if that's something you want to include. There are, I'll say, at least 50% of mutual funds have an exact replica ETF that's cheaper. And there's potentially more tax benefits there if you're holding it in a taxable account versus a mutual fund. And it's tradable all day. You're not going to day trade it. I get it. You're not doing that. But it has more liquidity. So if all things are equal, the performance is exactly the same. The positions, the underlying holdings are the same. But it's cheaper and I could just get out or add more or buy or do whatever I want in the middle of the day. Right? And it's cheaper, right? So it's kind of different. Anyways, 8% withdrawal rate with Dave Ramsey. I don't have currently any client who's withdrawing 8%. Now, keep in mind, old Jazz Wealth here, literally over 4,000 clients. Now, they're not all retired, so that's fair. But I don't have any client with an 8% withdrawal rate. Not because they can't, but because we're meeting their expenses and everything with a smaller withdrawal rate. So Suzy Orman says 3%. If you do that, $1 million account lasts you 30 years with Sequence of Returns Risk Incorporated. 4% withdrawal rate, which is traditional. I have no argument against that. You got about 25 years. For most people, that's what you're doing. Like, who's retiring at 40? You know what I mean? Like, what are you doing? 6% withdrawal rate, more aggressive. We do have some clients with a 6% withdrawal rate, just under that. But I understand that. And By the way, 6% withdrawal rate, part of that is not because they have to, right? Part of that is because we're solving for future tax problems, right? When you look at your withdrawals, we can't have a 4% withdrawal rate. It won't work. They will pay more in taxes than if they just withdraw 6% now. So that it's not always about expenses there. Dave Ramsey with the 8% withdrawal rate, unfortunately, it's only going to last you 10 years. Now, remember, he says invest 15%. So you might have more money to be able to do the 8% withdrawal rate. And I actually might agree with that if it's a lot of pre-tax dollars. So I'm not going to bash on that one. The other thing, Social Security, taking Social Security early, I don't like that one. I don't like it at all. When we say, or when you hear people say, take Social Security early, always ask why. Specifically, why for me do I take it earlier? Okay. And maybe it's an income issue. Maybe you have an inherited IRA and you have a 401k and you've only got a small number of Roth IRA dollars. You can tell, like, I've seen everything out there. So I'm painting a scenario. I don't like the idea of just saying, take it early, take it at full retirement age, wait till 70. No, I need to know why. I want to be more specific about that one there. So, and that's fair. Him and Suzy Orman can't possibly know where you stand with that. Long-term care. This one's a bit of I'm not going to be mad about it, but this one's a little different because I've seen so many people, go different directions. And so I tried to break it down for you. Dave Ramsey says you buy long-term care insurance when you're 60. You need to have your dough straight so you could buy long-term care insurance. Generally, great idea. Right? If you have if your plan, you work it out and you go, ooh, I don't quite have enough money for retirement, you're going to be looking more towards Medicaid. And I hope nobody has to do that, right? You're going to look to your family to help you out. And I hope nobody has to do that. But those that didn't save enough, you're not looking at long-term care insurance. You don't have the money liquid each month to pay for that. Usually, that's just from experience. If you're in the 500 to 2 million range, net worth anyways, you can look at different types of long-term care insurance. Chris is actually really good at that here, helping people navigate that. We don't sell it. We don't do anything, but he knows that stuff inside and out. It's unbelievably frustrating how good he is at this. And then if you have a higher net worth, meaning you've saved enough or you've got some property and you're going to sell it off and, use that asset to help fund your retirement, well, you're looking more at self-insurance. Long-term care is not as important to you. You might look at one of those insurance products that has a long-term care rider. Again, we don't deal with any of that, but I guarantee you Chris could tear them apart and make sure you're getting a good deal. Okay, when we talk about Suzy Orman here, she talks about this coffee thing, the Starbucks thing. She still does this to this day. I really don't like that. You know what I mean? You spend $5 at Starbucks and, you could have invested it and made $180,000. Okay, well, what? You went out to eat for your kid's birthday. You could have skipped that, and that was $200 or $300 because you went to Chuck E. Cheese and you got the extra pizza or whatever. I don't know where that ends. So I don't really care about that. If you have your plan in place, spend $6 a day at Starbucks. I don't care. We need to enjoy the things we enjoy now. And you get what I'm doing here. I'm not saying don't go to Starbucks. I'm saying if your thing is you're a smoker and you buy a pack of cigarettes, how many days do you guys smoke? I don't know. That's your thing. Try to talk you out of it, but it's not my job to do that. If you tell me you're going to spend whatever a pack of cigarettes costs every third, fourth, fifth day, okay, as long as that's not screwing up your retirement, now we're going to adjust your lifespan a little bit. You know what I'm saying? So the coffee thing, I don't really buy there. I don't like taking away what people tell me they like. This is just what I do. I go boating on the weekends. I spend $100 in fuel. Okay, great. It doesn't matter to me. As long as everything else lines up with where it needs to be, we're fine. She also talks about the 3% withdrawal rate. I'm a little bit of a stickler on this. Again, we talked about this a second ago. If you withdraw too little, even let's say you have a ton of money. If you withdraw too little, we're creating a tax problem in the future if more than 60% of your dollars are in pre-tax accounts. That's because of the old RMD rule, right? Now, I'm assuming you're retired. If you keep working and your money's in a 401k, well, we may not have the RMD rule, but that's just a rare thing. So her withdrawal rate of 3% makes the graph look good. Your money's going to last. It's going to last, but you're not going to end up with as much if you might have just withdrew more in the front years and then went down to a 3% withdrawal rate later in life. So there's a game to be played there. She's okay with ETFs. She has no problem with these. Dave Ramsey says only mutual funds. I'm actually okay with both. I just think you got to look at each one of them. I don't like, and I'm going to throw them out under the bus. You guys can hate me for this, or they can hate me for this. American funds, Capital Group, ripoff. And whatever comes of it, comes of it. They are the most expensive, stupid mutual funds out there on the planet. They tend to have front-loaded fees and yearly asset management fees. I don't agree with that. You can have one or the other. You can charge me, but charge me to invest in it or charge me yearly to manage it. One or the other. They do both. I don't like it. Other than that, I don't really have a problem with people that come to us and say, I would like to go with mutual funds. I don't want your stuff. I want to do this, or I want to be in some ETFs. I mean, as long as they're not the really pricey ones, I'm fine with that. Anyways, moving on. I'd like to talk about the prices. Speaking of that, got it in here. Mutual funds, remember, if you're not familiar with this, they are not traded between me, you, the guy next door, the guy down the street. When you buy one, you have to buy it from the mutual fund company. When you sell one, you have to sell it to them. There's one price per day that you get. You don't get to look at the price throughout the day. ETFs, you could sell to me, sell to anybody. You just press a button and sell it. They're usually highly liquid. So for that matter, they can be a little bit cheaper. And you know why? Because there's something called a rebate in the market. If you're familiar with this, it was really, really popular when I was a kid. We used to rebate trade all the time, which meant that the exchanges would pay us for placing orders. And I would just place 1 billion freaking orders all day like a little monkey, and I would get paid, not a lot, but I'd get paid for that. You don't with mutual funds because you're buying and selling from the company. And there could be, like I mentioned with American funds, there could be initial front-loaded fees. There could be added fees in there. So I wanted to put some of that stuff in there as well. Now, keep in mind that when I say index mutual funds, this 0.3%, that's all of them. That includes the capital funds. So you might look at that and go, I don't pay that. I pay 0.05%. Yeah, there's probably a lot that fit into that category. But because of the sort of nasty people out there, that average is skewed. So just so you know. And same with the ETFs. There are a few ETFs that, for whatever reason, think really highly of themselves, and that skews the average. All right. So when we look at 3% withdrawal rate versus 8% with Dave Ramsey, I kind of disagree with both of them. I disagree with Suzy Orman because I think that's not enough. I think you are taking too little to where we're going to create a tax problem down the road. You're going to pay 85% taxes on your Social Security. Your Medicare premiums are going to be higher. I worry about that. So we try to solve for that as well. She's just playing it conservative. It's not wrong. It's just she's playing it conservative. If we look at Dave Ramsey, I think that's too much because most people are not saving 15%, right? If you're saving 15% and your retirement goals are within reason, okay, it's probably fair, but what do we have? What's the problem here? What just happened in the stock market? It fell apart for a month or so and then recovered a little bit. What happened during COVID? It fell apart for a month or so and recovered. Well, what happens if you're withdrawing money during that time period? It's called a sequence of returns risk. Well, remember, Dave Ramsey says 8%, but you're going to be essentially all stocks. Remember the 4 groups there? You're going to be all stocks. You're going to have a higher sequence of return risk. So that means you're going to need more money to survive that type stuff. You're selling sometimes when the market's low. You're selling sometimes when the market's high. So I would wish, right, that he would say it's an 8% withdrawal rate that you hope to average over time. Now, some years you may not need in this case, the 80,000 or the 8%, right, with $1 million portfolio. You know what I mean? I wish it was something that was more variable. We find 9 times out of 10, I'll say 8 times out of 10, that a client's withdrawal rate actually varies by year because I'm trying to get money in their pocket earlier in life. We can reinvest it or something, but I'm trying to get money in their pocket earlier so that we run away from high RMDs that affect our Social Security and Medicare and things like that. So I'm just saying there needs to be a little bit more of a strategy there. Last couple things here. Social Security. This one bugs me, right? And I get it. They have to take a stance at some point. It's like a politician. Are you for this or are you against it? No. Why does it have to be one or the other, right? Everybody's a little different. So that would be probably a horrible answer if I was a politician. But if you claim early, 62, here's just a breakdown of the current, this was last year's averages. So you could actually see what happens there as you get from early as possible, full retirement age, and 70, which remember those credits get delayed until age 70. So that's a different thing. Okay. Lastly, basically what I'm trying to say is these two give great advice. And I'm not being political here, right? Someone's going to be like, oh, it's a nice way to dance around whether you agree or disagree with them. No, I really don't care for Dave Ramsey's approach. I like the tough love, right? Because that's Bruce Williams. That's where I came from. I like when he gets hard and tough on somebody and you're like, yeah, you shouldn't buy that Lamborghini. You know? I just disagree with his overall baby step approach because I don't think it fits everybody that's listening. I think there should be a little bit of nuance there, and there's not. So generally speaking, we need to focus on you, specifically what you want. Any financial planner, wealth manager, financial advisor, whatever is going to say, tell me about you. And that's missing, right? And it's not because they don't want to. I'm sure, Dave Ramsey recommends advisors, or there's something there. I don't know what that is. It's just because they can't. They're doing a television show. They're doing a radio show. They need to promote and excite the people that are calling in with unique problems where they can provide an answer that maybe somebody didn't think about. Okay. But there's only so far you can go. So that's why I'm saying I'm not bashing these people, but I would like to expand on it. If you'd like to expand on your finances, of course, I hope you'll check us out at jazzwealth.com. I hope you learned something here today. And just keep in mind that if you don't fit inside of a baby step or whatever Suzy Orman's doing, it's because you're unique. You are different. You have a different approach than whoever called in. And that's okay. We just have to solve for it. And we do that here at Jazz Wealth. Give us a call, schedule an appointment. You can, of course, do that. We have no sales pitch. I promise you no one will sell you anything on the phone except the fact that we're awesome. Laid back and unique. All right. That's all I got. Have a great rest of your evening. Adios.